China has always been the largest trading partner of the United States. If we graph out the largest trading partners of the United States in 2018, the year the trade war began, we get to see that China's total trade with the United States sat at over $659 billion, which was a massive figure that took over 15.7% of US total trade for that year. But ever since the trade war had started, China's role as the leading trading partner to the United States has but diminished. If we adjust this to 2023, which is 5 years later, we get to see that Mexico and Canada now far surpasses the trade volume of China. Here, you can easily see just how low the trade volume is between China and the US as compared to Mexico and Canada. This reduction in trade, as some may view, is a result of the ongoing tariffs and restrictions imposed by both countries during the US-China trade war. American companies began shifting their supply chains to other countries to avoid these tariffs, and Chinese exporters faced rising costs and uncertainties. As a result, countries like Mexico and Canada, which are part of the USMCA agreement, became more attractive and stable trading partners. But there is something that has caught the eye of many observers, and it's the fact that China, while its trade leadership has gone down, isn't actually backing out. In fact, it's still trying to capture some share in the American market, and this is done through a concept called nearshoring. What is nearshoring? It is when a company moves its production closer to the target market, but not necessarily inside that country. In China's case, many Chinese companies have started building factories or forming partnerships in countries like Mexico. This way, they can still sell to the US market without being directly hit by the heavy tariffs that come from exporting goods straight from China. Let me show you a graph on the amount of foreign investments coming into Mexico from China. Here, you can see that since the mid-2010s, China's FDI transactions in Mexico grew massively. In 2023, Chinese companies announced massive amounts of foreign investments worth more than $3.5 billion for that year. This is indeed partly driven by the fact that the US was introducing steep tariffs. Along the way, we also saw the COVID-19 pandemic and other supply chain disruptions, which exposed the vulnerabilities of having key components made an ocean away. Then thirdly, the new trade agreements and policies, notably the United States-Mexico-Canada Agreement, USMCA, that replaced NAFTA in 2020, have reinforced North America's attractiveness as an integrated production base with preferential access to the US market. Mexico, therefore, emerged as one of the biggest winners of this nearshoring trend. With its geographic proximity to the US, competitive wages, and network of free trade agreements, Mexico offers a compelling alternative to Asia for serving the US demand. And that is one of the reasons why products that are going into the United States now come from Mexican factories instead of Chinese factories. This isn't a shift limited to Chinese investments alone. Many investors, if we graph out the FDI in Mexico by year, we get to see that money continues to flow in by the sum of billions of dollars. Even though we don't really see a dramatic increase, it is a good reminder that in the years following the USMCA agreement, we have lived through a high-interest environment where borrowing money for big projects has become more expensive. So, the fact that billions are still flowing into Mexico shows that investors believe it's worth it. So, with this understanding, China is indeed trying to capture the American market amidst the tariff restrictions placed in their country by nearshoring to Mexico. But while FDI data does show us just how much China is investing into Mexico, it doesn't really tell us the entire picture. One of the other ways is in the fact that Chinese exports to Mexico have grown massively. Here's a graph on the exports of China to Mexico. Here, you can tell that exports have exploded. In 2017, the year Donald Trump came into office, China's exports to Mexico stood at only $35.9 billion. But by 2023, it grew more than double to over $81.5 billion. It is a good reminder that at the same period, from 2017 to 2023, Chinese exports to the US shrunk in value, which means that China may be rerouting some of its exports through Mexico. You can also see how this plays when we take a look at the Chinese imports from Mexico. Here you can see that while imports grew, it's still very small as compared to the overall exports. What that basically means is that China is sending far more goods to Mexico than it is buying from them. This trade imbalance suggests that a large portion of these Chinese goods might not be intended for the Mexican market at all. Instead, they're likely being processed or passed through Mexico on their way to the US. But we still can't prove that from just this data, right? Well, to prove that, let's graph out the exports of China to Mexico by category. Here you can see that electrical and electronic equipment take up the largest, with over $22.33 billion. This category is important because, according to various reports, Mexico now supplies the bulk of TVs sold in the US, and a lot of the TV makers in Mexico are known as Chinese companies: Hisense, TCL, and others. For instance, Hisense Group, a famous TV-branded Chinese company, took over a Mexican plant in 2016, which produced over 8.5 million units in 2021, most of which were destined to the United States. Similarly, there are also other brands like Manhua, which is a furniture company that opened a large sofa factory in Nuevo León in 2022, and its recliners and sofas are shipped tariff-free to US retailers like Costco and Walmart. In other words, while it may seem like these products are made in Mexico, some of them may be backed by Chinese capital, Chinese supply chains, and in some cases, even Chinese workers and machinery. There are just two problems with this. It's in fact that nearshoring isn't as big as one may think. Well, at least not in the short term. If we graph out the largest investors in Mexico for 2022, we get to see that China stood as the second largest. If we adjust this, however, for 2023, it doesn't actually show China in the list. That is because Chinese FDI has shrunk down to a point where it doesn't reach the top spot. So, in other words, while China has been investing in Mexico for some years, it isn't really that big at all. The only good part is that Chinese companies have announced billions of money into Mexico, some of which may not fully show up in FDI statistics. For instance, here's a table on some of the announced Chinese investments in recent years. Here, you can see that the announced investments are billions of dollars. But some of them, like all other Chinese investments, may not show up yet, as these are expected investments. In 2023, Chinese companies reportedly made investment announcements totaling $13.19 billion for future projects, making China the second largest in expected investment announcements that year, behind only the US. Now, there's another problem, that it's the fact that Washington isn't blind from all these. Lawmakers have increasingly voiced concern that China is circumventing tariffs and trade rules via Mexico. For example, a group of US senators introduced the Stopping Adversarial Tariff Evasion (STATE) Act to crack down on country hopping, essentially aiming to ensure that Chinese goods don't avoid tariffs simply by routing through a third country. Another proposal, the Protecting American Auto Workers from China Act, floated by Senator Josh Hawley, calls for higher tariffs on vehicles from Chinese automakers, no matter where they are built. In September 2024, a bipartisan group of 20 US lawmakers even wrote to Mexico's then incoming president, Claudia Sheinbaum, urging Mexico to review Chinese automakers' investments on national security grounds. The backdrop to this is the worry that Chinese electric vehicles, which are very cost competitive, might flood the US via Mexican plants, undercutting US and European car makers. Washington strategists also note that Mexico's central role in North American supply chains could be exploited by China to gain technological insights or dependencies that the US finds undesirable. And the biggest drawback that may have hit China through its nearshoring plans can be traced to the new Trump administration. In early 2025, the Trump administration explicitly threatened a 25% tariff on all cars imported from Mexico, with a particular eye on stemming a potential wave of Chinese-made vehicles. This raised the question over the viability of billions of Chinese planned investments. But this has become a reality, not just for car imports, but for all Mexican imports. Effective March 4, 2025, a 25% tariff was imposed on most goods imported from Mexico. This action was taken under the International Emergency Economic Powers Act, IEEPA, and was justified by the administration as a measure to address illegal immigration and drug trafficking concerns. On the 26th of March, Trump announced a 5% tariff on all imported cars and light-duty trucks, including those from Mexico, set to take effect on April 3, 2025. Additionally, a 25% tariff on auto parts is scheduled to be implemented no later than May 3, 2025. In other words, China's nearshoring plan could be at risk. While the strategy had been clever, using Mexico as a back door to the US market, the new tariffs threaten to close that door entirely. But anyway, do let us know what you think. Thanks for watching.